In this session, the topic of discussion will be the center-state financial relations in India. A federal setup is considered to be the best form of government as it combines the strength of a unitary system as well as a federal form of government. Now, what is known as a unitary system? When power is concentrated in the center, it is called a unitary system. What is a federal form of government? When there is nearly absolute devolution of power or sharing of power between the center and the states, it is called a federal form of government. It is to be kept in mind that there can be no system which is absolutely unitary or absolutely or completely federalism. Debate is regarding the degree of decentralization of power. That is, in unitary system, this decentralization is in lesser amount. In federalism, it is more. While deciding on the nature of federalism, the points which occupy its primary attention are the distribution of administrative, legislative and financial powers between the center and the states. In Indian Constitution, we can find that there are a number of constitutional provisions which allow for this distribution of power between the center and the states. However, nowhere in the Indian Constitution it has been said that India is a federal country. Article 1 of the Indian Constitution says that India, that is Bharat, is union of states. Now, coming to the point of distribution of power, it must be kept in mind that distribution of financial power lies in the core of the concept of power sharing. The successful existence of federalism depends on balanced diversion of financial resources both to the union and the states. In a federation, all the federated units would like to enjoy autonomy. At the same time, they would like to keep a strong link with the center for several reasons, like legitimate access to global economy, unified market facility, technological help, military help, financial cooperation, and so on. In India, federalism has taken a unique shape due to the influence of Westminster model of governance as well as its historical link with a unitary system evolved under the British regime. Lord Mayo Financial Resolution of 1871 designed a three-tier form of federation with a strong central bias. Then came the next landmark, that is 1919 Government of India Act, which provided for a dual form of government, that is diarchy. This 1919 Government of India Act was a major landmark in the history of fiscal federalism in India. The most significant in this respect was Government of India Act 1935. It provided for devolution of financial powers between the center and the provinces. Though federalism grew as per this Government of India Act 1935 under strong central leadership. This trend was followed in independent India. In independent India also, federalism was to sustain under strong central guardianship. That is, a patriarchal control over the federal units became the trend which was being followed by the framers of the Indian Constitution. Since 1991, with the growing demand for economic reforms, the responsibilities of the states increased. And there has been a trend for discretionary transfers of financial resources to the states. The situation is really alarming as the burden of developmental works mostly lie with the states. The Government of India Act 1935 divided the revenue sources into three categories: exclusively federal, that is the areas which exclusively belonged to the Union, exclusively provincial, that is the areas which were exclusively diverted to the provinces, and the third category was subdivided under two heads. One, taxes levied by federal government but shared with the provinces or assigned to them, and second one was taxes levied by the federal government but collected and retained by the provinces. There was also the provision for grants in aid. Union Powers Committee of the Assembly evolved a scheme of revenue sharing which resembled mostly with the provisions of the Government of India Act 1935. The Constituent Assembly recommended sharing of some more taxes, that is a bit of relaxed sharing of certain more taxes with the states, and it also recommended that some fields of taxes may be distributed between the Union and the states. It further recommended that there should be no concurrent field of taxation. So, these were the basic principles which guided the evolution of financial relations between the Union and the states in independent India. Financial arrangements under the Constitution of independent India have two main aspects. First one relates to distribution of taxation heads, and the second one relates to distribution of revenues and sharing of resources between the Union and the states. So far as the first aspect is concerned, it is being dealt with by Article 246, 248, 265 to be read with Legislative List 1 and 2 as enlisted in the 7th schedule of the Indian Constitution. So far as the second aspect is concerned, it has been written in chapters 1 and 2 of part 12 of the Constitution. There is no head of taxation in the concurrent list. The residual power of taxation lies with the centre. There are numerous taxation heads enumerated in entries 82 to 92b in the Union list and entries 45 to 63 in the state list. So far as the items of Union list are concerned, centre is authorized to levy the taxes on the items of Union list and to legislate in this respect. So far as the items in the state list are concerned, state legislative assemblies, they are authorized to levy taxes on such items. What is the principle of allocation of heads of taxation? Allocation of heads of taxation between the Union and the states is based on the broad principle that taxes which are location specific and relate to the subjects of local consumption will belong to the state, and those taxes which are of interstate significance and where the place of residence is not a correct guide to determine the amount of taxes have been vested in the Union. As we know that no system of federation can be successful unless both the Union and the states are having access to adequate financial resources to enable them to discharge their respective responsibilities under the Constitution. Indian Constitution has made elaborate provisions relating to the distribution of taxes as well as non-tax revenues, the power of borrowing supplemented by the provisions of grants in aid to be provided by the Union to the federated units. It is to be noted that Indian Constitution makes a distinction between the legislative power to levy a tax and power to appropriate the net proceeds of the taxes so levied. The legislative power to make a law for imposing a tax is divided between the Union and the states. Some of the sources of revenue for the Union government entered in the list 1 of the 7th schedule: taxes on income other than agricultural income, customs duty including export duties, duties of excise on tobaccos and other goods, except alcoholic liquors, opium, Indian hemp, etc. Corporate taxes, taxes on capital value of assets, estate duty in respect of property except agricultural land, duties in respect of succession to property except agricultural land, taxes in sale or purchase of newspaper and advertisements published therein, etc. There are certain other sources of revenue for the union government. Income from business enterprise and government monopolies, for example, railway, post and telegraphs, salt manufacture, etc. Income arising from the sovereign rights and functions of the states, that is, the income on property accruing from lapse or escheat, etc. Sums raised by the government, etc. Some of the sources for the state: land revenue, taxes on agricultural income, duties on succession to agricultural land, estate duty in respect of agricultural land, taxes on land and buildings, taxes on mineral rights subject to limitation imposed by law, excise duties on alcoholic liquors, opium, hemp and other narcotics, taxes on entry of goods into a local area for consumption, use or sale. There are certain other sources of income for the states: business enterprise, transport, fisheries, etc., royalty from mines, forest revenue, treasure trove, etc., grant and aid from the union government, borrowings, etc. There are also other heads. I have mentioned only a few. This clear-cut division of heads of taxation was expected to minimize the scope for conflict and litigation between the union and the states. There are taxes which are levied and collected by the union, and their proceeds will go entirely to the union. All the taxes mentioned in the union list belong to this class except those about which some other provisions are made in the constitution. From the point of view of actual allocation of their proceeds, the union sources of taxes fall into 5 categories. There are taxes which are levied and collected by the union and their proceeds entirely go to the union. There are taxes levied by the central government but collected and appropriated wholly by the states. There are taxes and duties which are levied and collected by the union but are assigned to the states. Taxes on income other than agricultural income are levied and collected by the Government of India and distributed between the union and the states. There are provisions for imposing surcharges, that is increased rate, which are levied by the union government on taxes and duties mentioned in Article 269 and 270, and its proceeds entirely go to the union. Article 268. Duties levied by the union but collected and appropriated by the states. Such stamp duties on bills of exchange, etc., and excise duties on medicinal and toilet preparations, as are mentioned in the union list, fall in this category. Remember, these are collected and appropriated by the states within which such duties are respectively levied. If it is leviable in the union territory, then it is collected and appropriated by the union government. Such taxes shall not form the part of the consolidated fund of India, but shall be assigned to that particular state. Article 269. Taxes levied and collected by the union but assigned to the states. Taxes on the sale or purchase of goods and taxes on the consignment of goods shall be levied and collected by the Government of India but shall be assigned to the states with the explanation that such sale or purchase must take place in course of interstate trade or commerce, or where such consignment takes place in the course of interstate trade or commerce. Article 270. Taxes levied and distributed between the union and the states. Such taxes as on income are levied and collected by the Government of India and distributed between the Union and the states. As per the recommendation of the Finance Commission, such taxes shall not form the part of the Consolidated Fund of India. For example, taxes on income other than agricultural income. Article 271. Surcharge on certain duties and taxes for purposes of Union. Such surcharge on duties, except notwithstanding anything in Articles 269 and 270, shall form the part of Consolidated Fund of India. Article 272, it has been repealed by the Constitution 80th Amendment 2000. Article 273, grants in lieu of export duty on jute and jute products. Such grants shall be charged on the Consolidated Fund of India as grants in aid of the revenues of the states of Assam, Bihar, Orissa, and West Bengal. The sums so prescribed shall continue to be charged on the Consolidated Fund of India so long as any export duty on jute or jute products continues to be levied by the Government of India or until the expiration of 10 years from the commencement of this constitution, whichever is earlier. Article 274. Prior recommendation of the President is required to bills affecting taxation in which states are interested. Article 275, it's a very significant article considering the status of the states. It provides for grants to be provided by the Union to the states. Such sums as the Parliament may by law provide shall be charged on the Consolidated Fund of India in each year as grants in aid of the revenues of such states as the Parliament may determine to be in need of assistance. Thus, different sums may be fixed for different states. Herein lies the main possibility of political tuning. The decision is left with the Parliament and there is no fixed rule regarding distribution of grants. Article 276. No law of the legislature of a state relating to taxes for the benefit of a state, of a municipality, a local board or district board shall be declared invalid on the ground that it relates to a tax on income if it is imposed on professions, trades, callings or employments. The power of the legislature of a state to make a law as aforesaid with respect to taxes on professions, trades, callings and employments shall not be the part of consolidated fund and shall not be considered as limiting in any way with the power of the Parliament to make laws in respect of taxes on income. There are certain sources which can be generated through non-tax revenue. Non-tax revenue for the Union are as follows: receipts from railways, post and telegraphs, broadcasting, opium, currency and mint, industrial, commercial undertakings of central government relating to the subjects over which Union has the jurisdiction, etc. There are certain sources of non-tax revenue for the states. They are forests and irrigation and commercial enterprises, industrial undertakings such as soap, sandalwood, iron and steel in Karnataka, paper in Madhya Pradesh, milk supply in Mumbai, fishing and silk in West Bengal. Article 280 provides for constitution of a finance commission. A finance commission may be constituted by the President within 2 years from the commencement of this constitution and thereafter at the expiration of every 5th year or at such earlier time as the President considers necessary. By order, he is authorized to constitute a finance commission which shall consist of a chairman and 4 other members to be appointed by him. Such a finance commission can recommend as to the distribution between the union and the states of the net proceeds of taxes, the allocation between the states of respective shares of such proceeds, the principles which should govern the grants in aid to be provided by the union to the states, the continuous modification of the terms of any agreement entered by the union government with Part B states as mentioned in the first schedule, and any other matter referred to the Commission by the President in the interest of sound finance. Finance Commission recommends the requisite changes derived on the basis of experience and resources generated. That the net result of recommendation of successive Finance Commission has been a progressive increase in the amount of union grants to the state under Article 275 of the Constitution, which is often having a political flavor. Further, the Finance Commission is an advisory body whose recommendations may not be accepted. Political commitments or obligations may arise. This is not healthy for a sound federal structure. However, first Finance Commission was appointed on November 30, 1951. It submitted its report on December 31, 1952. First Finance Commission recommended that the additional transfer of resources from the center must be such as the center could bear the responsibilities of defense of the country and could act for the sake of stability of country's economy. Principles for distribution of grants in aid must be uniformly applied to all the states. The scheme of distribution should attempt to lessen inequalities between the states. Last but not the least, there are emergency provisions which curtail fiscal autonomy of the states. Proclamation of emergency under Article 352. Divisions of the taxes between the union and the states and the scheme of providing grants in aid to the states remains suspended as per Article 354 if there is national emergency in accordance with the Article 352 of the Constitution. If financial emergency is proclaimed as per Article 360, Union becomes authorized to give directions to the states. Now, on the basis of these discussions, we can focus on certain outcomes. There is a fiscal imbalance which is prominently visible in case of Indian federalism. Fiscal equalization is under big question. Fiscal insufficiency of the states is getting a problem for the states, especially following the courses of economic reforms since 1991. Union is assuming the role of a guardian, which is anti-federal norm, which is basically unfederal feature of Indian Constitution. Overall, Indian federalism is having an unfederal twist not only because the distribution of legislative and administrative relations, but also because of the distribution of financial resources to the between the union and the states. This unfederal twist of Indian federalism must be reviewed and must be modified with all seriousness to promote a healthy federal spirit among the states as well as the central political leadership.